Hello everyone, welcome to my lecture on Unit 5 Topic 4, that is types of ratios. In today's session we are going to learn about the last set of ratios under ratio analysis, that is profitability ratios. The profitability ratios generally throws light on how well the firm is organizing its activities, in a profitable manner, and the owner expects reasonable rate of return on their investments, and the main purpose or the objective of the firm is to generate enough profit not only to meet the expectations of the owners as well as the stakeholders, but also to finance the expansion and diversification activities of the business. The following are the 8 ratios that are commonly used to explain profitability, that is gross profit ratio, operating ratio, earnings per share, price earning ratio, net profit ratio, return on investment, dividend yield, and earning power. We'll begin with the first type of profitability ratio, that is gross profit ratio. It is a ratio between the gross profit to sales during a given period, and it is expressed in terms of percentages. So gross profit ratio is equal to gross profit divided by sales into 100. Higher the gross profit ratio, the better it is for the firm. Suppose the net sales are worth rupees 50,000 for a firm, and the cost of the goods rupees 50,000 and the cost of the goods sold is rupees 20,000. The gross profit is calculated as below. Gross profit is gross profit divided by sales into 100. How is gross profit ascertained? Gross profit is ascertained as net sales minus cost of the goods sold. Net sales is 50,000 minus 20,000 is 30,000 is a gross profit. So in other words, 60% of its sales is gross profit. That is 60% of the total sales is the gross profit earned by the firm. Net profit ratio. It is the ratio between the net profit after taxes and net sales. It indicates what portion of the sales is left to the owners after operating expenses are incurred or spent. Non-operating income such as interest on investments, gain on sale of fixed assets, and so on are added to the operating profit, and non-operating expenses such as loss on sale of fixed assets and so on will be deducted from such profits. The meaning here, what does it is this particular point indicate is only the expenditures and the incomes which are generated in the course of conducting your business or operating the business is only considered for the calculation of your net profit ratio. So this is the net profit after adjusting non-operating incomes and non-operating expenses. So net profit is equal to net profit after taxes divided by net sales into 100. There's a small data provided for you with few items in it. Suppose the net sales of the firm is 50,000. and the cost of the goods sold is rupees 20,000. The details of expenses are given below. The administrative expenses is an operating expenses. Selling and distribution expenses is an operating expenses. Loss and sale of fixed assets is non-operating expense. Interest on investments is another item, and tax is at 20% is given to you. So this is the statement showing the adjustment of all the relevant items to the sales. so that we arrive at the net profit after taxes. We'll begin with the first one. Sales figure is 50,000 less the cost of the goods sold is already given in the data. The same is deducted from the sales. So the resulting value, that is 30,000, will be your gross profit. Gross profit. So to this gross profit, you are going to adjust or reduce the selling and distribution expenses and the administrative related expenses. So that is amount 8,000. So 30,000 minus 8,000 is resulting figure will be your net profit. So from this again, we are adding interest on investment on which is a non-operating income, adding and reducing the loss on sale of assets, that is non-operating expenditure. So when you are adding 2,000 to 22,000 net profit, the resulting value will be 24,000, and from which we are deducting 3,000 as a non-operating expenditure. So the resulting figure is profit before tax, that is net profit before taxes. From this profit before taxes figure, reduce 20% of tax on the profit. So the resulting figure will be your net profit after taxes. This can also be written as net profit before taxes. So this is how the net profit after taxes is ascertained. So net profit ratio will be net profit after taxes divided by sales into 100. Net profit after taxes divided by sales into 100 will be your net profit ratio. Substituting the values, you'll be getting the ratio here. Coming to the next one, it is operating ratio. Operating ratio is the ratio between cost of the goods sold plus operating expenses and the net sales. The higher the operating ratio, the lower is the profitability, and vice versa. Operating ratio is this is the formula used to calculate the operating ratio. That is nothing but operating expenses divided by net sales into 100, where operating expenses will be ascertained by considering these items, that is cost of the goods sold, administrative expenses, selling and distribution expenses. There's a small problem here with few data. Net sales is 20 lakhs of company ABC. Operating expenses is almost all tuning to rupees 14,000. The operating ratio is operating expenses divided by net sales into 100. This operating expenses is 14 lakhs divided by 20 lakhs into 100, which the ratio is 70%. Return on investment. Return of an investment is one of the very important parameters affecting business plans. The overall profitability of the firm is measured in terms of return on investment only. The term investment may refer to total assets, capital employed, or owner's equity. So basically, return on investment is calculated on the net profit after taxes divided by the total investments. So some of the ratios which come under this particular head are return on capital employed and return on equity. Return on capital employed is this formula. Adjusted net profits divided by capital employed, and return on equity is net profit minus dividends payable to preference shareholders divided by equity shareholders. Higher the return on equity is, the more is the profitability, and vice versa. Earnings per share. Earnings per share is the relationship between the net profits and the number of shares outstanding at the end of a given period. This can be compared with previous years to provide a basis for assessing the company's performance. So EPS is calculated by using this formula, that is net profit after taxes divided by number of shares outstanding. Now number of shares is given as 10,000 and net profit after taxes for a given period is 4,50,000 and EPS is supposed to be calculated. Earnings per share is to be calculated. Substituting the values, it is coming to 45 rupees. Higher the EPS, the more is likely to be the demand for the shares of the company. However, it is to be noted that EPS is one of the many affecting demand for the given share. Dividend yield. Dividend yield refers to the amount of total return the investor will receive for a given period of time for the amount what he has invested. This dividend yield also refers to the percentage return on the price paid for the shares. So the general formula used for calculating the dividend yield is the nominal or face value of the share divided by the cost or market price of the share into percentage dividend per annum. Now here the face value of the share refers to the initial price of the shares at the time of issue. This is generally decided by the firm, whereas the market price of the share is the price of the share listed on stock exchange. So here is a simple small problem given for us. Given that current market price of the share is 300, face value of the share is 100, dividend declared is 20%, then dividend yield is calculated by using this formula, that is face value of the share, that is 100 rupees, divided the market price of the share into dividend per annum. This is also otherwise calculated using another formula, that is dividend yield is equal to annual dividend divided by market price of the share into 100. Generally, this annual dividend is calculated on the face value of the share rather than the market price of the share. So if you simplify these figures, it is coming to around 6.66% per annum. The higher yield reflects that the investments are riskier, and the lower yield refers safer are the investments. So generally, the yield, that is dividend yield, and risks are inversely proportional. Price earnings ratio. Price earnings ratio is the market price per share divided by earnings per share. So market price for the share, if it is 340 rupees and earnings per share is 10, calculate profit earning ratio. Substituting the value in the formula, earnings per ratio is 34 rupees 34. Thus a share with market price of 350 and earning EPS is 10 would have a price earning ratio equal to 34 rupees. This is how all the profitability ratios are calculated with the respective formulas. With this, I'll end up the session here. Thank you.